Second quarter growth figures out a short while ago show the economy grew by a slower than expected 3.2%. The market was looking for a reading of about 3.6%. That's after 4.6% growth in the first quarter. Joining us with more on that is Sizwe Nxedlana. He's a senior economist at FNB Commercial. Sizwe, thanks very much for coming in. I know the market was looking for 3.6%. Some of the banks looking for something a little bit lower. What was your expectation there?
No, we were looking for something just slightly higher than market consensus. So obviously we're a little bit more disappointed than others. But I think this figure here was driven mainly by manufacturing production, which was encouraging. Government's counter-cyclical fiscal policy seems to be, still in place. And another encouraging sign was that finance, real estate, and business services also made a major contribution, as did the internal trade sector. So GDP was slower than what was expected, but it does seem that we've got a slightly broader base in terms of sources of growth.
Yeah, well, I mean, as Rob was saying, I think you were listening into that. Mining was quite a big pull-down factor there. In fact, we had mining and quarrying shrinking by about 20% in the second quarter. Of course, that tallies in with the mining numbers we saw, I think, last week. Do you see the sector turning around as the recovery starts to gain a little bit of traction in South Africa?
Well, there's been somewhat of a recovery in commodity prices. So, and what Stats SA has said is that it was due to industrial action and some maintenance issues. So those are possibly once-off operational factors that led to this massive decline, not necessarily, structurally lower mining production. So one would expect, and it does tend to be a very cyclical and very volatile number when looked at quarter on quarter. So one would expect going forward that we do see some sort of recovery in the mining sector. Although longer term, there is a lot of policy uncertainty that's been emanating from the mining sector. So, on the one hand, we think that it should recover from a cyclical perspective, but structurally long term, those structural issues and policy issues need to be sorted out.
Of course, you did mention industrial action affecting the mining sector. Of course, we had that Transnet strike, which took place, I think, right at the beginning of the second quarter. And that was also perhaps hampering further growth in the manufacturing sector, wouldn't it, perhaps? Because we had manufacturing growing by 6.9% after 8.4% in the first quarter.
Yeah, but if you obviously the Transnet strike would have had some sort of negative impact. Possibly, if it did not occur, manufacturing production in South Africa would have been even better than it has been now. But manufacturing has been one of the star performers after bottoming in the second quarter of last year. We really have had a strong V-shaped recovery in the manufacturing sector. The worrying thing now is that we are seeing the purchasing managers indices, which are the leading indicators of the sector, suggesting that we might have a slowdown in manufacturing production domestically in the second half of this year. It's also borne out by the Q2 BR survey data that showed somewhat of a dichotomy or a divergence between manufacturers' expectations of internal sales volumes versus very weak expectations of exports. And I think that ties in with the fact that quite a large chunk, I think it's just under 40% of our manufactured exports go to the Eurozone, which is expected to show very weak growth over the next year or two.
Of course, we know that the rand at current levels isn't helping the manufacturing sector either, is it?
Yes, definitely not helping the manufacturing sector. However, it's not necessarily only a rand issue. One mustn't narrow the debate. It's also overall a productivity issue in South Africa. The strike actions, particularly in transporting goods in and out of South Africa, also has a negative impact. So you can't just blame the rand. It's the logistics chain, it's labor productivity, and also possibly a more competitive exchange rate.
Of course, we had Reserve Bank Deputy Governor Daniel Manelli speaking last week, talking about growth of about 3% for this year. Is that a figure that you'd concur with? Do you think we will grow the economy by 3% this year?
No, I think we're looking for growth of between 3 and 3.5% these next 2 years. Our exact point estimate is 3.3% for 2010 and 3.5% for 2011. I think after this V-shaped type of sorts recovery in the last 12 months, I think what we're going to see going forward is possibly the fact that in the last 12 months the recovery was driven by inventory adjustment, counter-cyclical government spending and strong exports, which led to very strong supply side growth. What we've seen in the first 6 months of this year is that retail, wholesale and motor trade have also come to the fore. So the PMIs are telling us that maybe the export-led growth, the inventory adjustment and the supply side is probably going to be slower, but we think that it's going to be compensated for by better household consumption and therefore better retail and wholesale sales and motor trade. And the reason why we are slightly more bullish on the internal trade sectors is that a lot of the drivers of household consumption expenditure, I'm talking about lower inflation, lower interest rates, double-digit wage growth, and high, relatively high consumer confidence. Those are all pointing towards, a gradual increase in household consumption expenditure. Of course, there will be speed bumps, and I'm talking about high unemployment and record high household indebtedness that may mean that it's only a gradual recovery.
How about the public sector strike that's currently underway? We had Finance Minister Praveen Gordhan last week saying it shouldn't affect growth this year. But if this becomes a protracted strike, and at this stage it looks like it could become a protracted strike, do you think that that could be a threat to growth?
I have no doubt that it could be a threat to growth, but obviously it depends on how long the strike is. And it's not a direct impact on growth, but it's an indirect impact on growth in the sense that it has an impact on the logistics chain and on public sector service delivery, which then affects private business enterprises. So the longer it carries on, the more detrimental it could become for this 3.5% forecast that we're looking for.
CPI out tomorrow. I think the last reading was about 4.2%. Yeah. What would you be looking for there, and how's that going to influence the Monetary Policy Committee, which meets quite early in September?
We're looking for CPI growth of around 4%. In terms of the monetary policy stance, the odds of another rate cut, I think, are increasing. I think it's now slightly better odds that we might see a rate cut in the September.
Because of the growth figures today.
Well, relatively disappointing growth figures, and the expectation that we might see slightly slower growth as the leading indicators, particularly on the supply side, are showing. Inflation is lower, much lower than what the SARB expected. The rand is weak. Global inflation is very low. Global growth is also very low. So I think there's definitely a chance, obviously a chance for rates to be reduced. Obviously, the one worrying factor, the main worrying factor, are these public sector tariff increments and the impact particularly of the electricity that we're also worried about at the beginning of the year. What impact does that have on inflation going forward, and will that be strong enough influence on the SARB to render them keeping rates stable rather than all this other evidence, which I think is now overwhelming for them to possibly stimulate a little bit.